All right. Okay. Welcome everybody to this new version of the Appcast brief. Super happy to discuss today's jobs report and recruitment insights today. So we're trying out this new format. It's a Microsoft Teams webinar right now. If you have any questions, drop them into the Q&A. And so I'm going to talk first a little bit about the jobs report and the labor market, but let me also introduce my two colleagues who joined me here today. Lance, do you want to introduce yourself?
Sure. Hi, everybody. My name is Lance Christensen. I'm Senior Director of Strategy over at Appcast. My specialty is solving complex recruitment challenges that our clients face. And yeah, I'm happy to be here.
Josh?
Hello, I am Josh Previte. I'm an economic data analyst here on our data and insights team. I work pretty closely with some of the regular members of the Appcast brief, Liz, Sam, some of your favorites. But you probably also see me here once before on the Appcast brief back in the fall. But my day-to-day is really investigating industry trends, benchmark, cost per applications, things like that. I'm so happy to present some on this Appcast brief.
Great. And I'm Julius. I'm a labor economist working for Appcast. I write on our blog. I mostly report on European labor market trends, but today I'm going to guide you through today's jobs report. So Josh, maybe we can just start sharing our presentation. So today's jobs report was really actually a very good report. Yeah. So it's been kind of like a very good start of the year for the US labor market. If we go to the first slide, then you can see that there were some 275,000 jobs added in February. And so over the last 3 months, an average of about 260,000 jobs have been added every single month. And that is a very good jobs report for the last few months. That's kind of like still way above long-term trend. Yeah. If we go to the next slide, then there's one thing to notice though, and that is that there were also some downward revisions. So even though the February jobs number of 275,000 was extremely good, there was a negative revision of roughly 130,000 jobs to the January report. Yeah, so if you look at the blue bars, that was the initial data release, and the number for January was revised down by 130,000. So that's a pretty big downward revision. But overall, as I said, the last 3 months, on average, 260,000 jobs have been added still. Yeah, so the US labor market is still very healthy. And if we go to the next slide, then we can actually see that in this chart. The unemployment rate ticked up slightly from 3.7 to 3.9%. But this is probably most likely due to more people looking for work and getting into the labor force. And so the lower part of this chart is showing you that we now have 27 consecutive months of an unemployment rate at or below 4%. Yeah, so if you look at the previous decades, this has never happened, and we are now enjoying one of the longest spells of like very low unemployment rates. So it's still a very healthy labor market in the US. If you go to the next slide, then you can see that labor force participation is also very high. Yeah, so obviously there was a big drop during COVID, but for prime age workers, so those between 25 and 54 years old, the participation rate now is above 83%. It's at 83.5%. And that is exceeding the participation rate at any point in time in the 2010s. And you have to go back to the early 2000s to see such a high participation rate. Yeah. So, and the next slide will also show you that the employment rate for prime age workers is also extremely high and has completely recovered from the COVID economic shock. Yeah, so for prime age workers, we have like 80% employment right now. So a very healthy labor market in general. I'm just gonna tell you a little bit about the sectoral breakdown of job additions now in the next couple of slides. Yeah. So, but before we go into that, just one note about wage growth. So wage growth ticked down slightly in this jobs report. You see that the monthly data is relatively volatile. If you look at the smooth data, the 3-month average, it went down slightly as well. So this is probably good news for the Fed, who is watching this data closely. So for the Fed, inflation is still a little bit too high. It's still a little bit above target. And wage growth has been also still above what would be consistent with true inflation until recently. So this combination of wages coming down a little bit, but still very healthy job gains are kind of like perfect for the Federal Reserve and will make their life easier. Yeah. And so if we go to the next slide, let's just discuss a little bit the sectoral breakdown. So education and health services added some 66,000 jobs. Leisure and hospitality added some 60,000 jobs last month. Construction added some 20,000 jobs. So especially leisure and hospitality stands out for some very healthy gains in February compared to the month before. But really, the education and health sector have been adding a lot of jobs over the last half year, and it is one of the main reasons why job reports have been so strong. Yeah. If you go to the next slide, just looking a little bit again at different industries. This is information and communication. So the last couple of months, there have been some very small job gains. The job gain in February was very small. And here you can see that obviously the IT sector, information and communication, suffered a lot for 1 year throughout most of 2023. But the last couple of months have seen positive job growth. Yeah. Next slide. Healthcare, as I said, is kind of like one of the strongest sectors and has seen extremely strong job growth over the last 2 years. And on average, every single month, we are seeing like an average of like 50 to 60,000 or even slightly more jobs gained in the healthcare sector. So this is like one of the sectors that is contributing every single jobs report. Like we've seen very, very steady gains there. Next slide. Construction is also interesting. So the construction employment has also still been going up, and we are seeing every single month some steady gains of 20,000 per month. This is interesting insofar as interest rates obviously have been going up a lot and have been staying at above 5% for quite long now. The Fed is keeping interest rates very high. And if 2 years ago somebody would have told me that interest rates would be so high, I would have said like real estate and construction is one of the first industries to suffer a lot, but we are not really seeing it in the data. So the construction sector is still adding jobs every single month, and on a monthly basis, some very steady job gains of about 20,000 over the last year or so. Next slide. Leisure and hospitality also saw some good job gains in February, and that sector obviously suffered a lot during the pandemic, but has now basically completely recovered, and total employment is now back at pre-pandemic levels. Yeah. Next slide. Yeah, one thing to note: transportation and warehousing. Here we have one sector that has seen quite steady job losses, even though they haven't been very large, but quite steady job losses throughout 2022, late 2022 and early 2023. Now last month, the sector has gained jobs finally again, so maybe this long spell of job losses in transportation and warehousing is finally over. Yeah. Next slide. And last but not least, just one more chart to discuss from a macroeconomic point of view. What you see here is the Atlanta Fed GDP nowcast for the first quarter of this year. And this one still stands at 2.5%. So at the moment, this nowcast suggests that the US economy will continue to see very strong real GDP growth. And as I discussed, job growth has been relatively strong despite some downward revisions for last month, and wages are coming down. So actually, this kind of like jobs report together with other economic data is extremely good news for the Fed. And as for now, there's really no recession in sight. And that takes us to the news to the next session. Josh.
Awesome. Thank you, Julius. In this section, I'm going to go over some benchmark cost per application, apply rates. But before I get into that, I did want to quickly plug our annual benchmark report. I believe this is the first Appcast brief. That has happened since we released the benchmark report in February. So if you like this kind of data, looking at, again, cost per application, apply rates, cost per click, things like this across industries, this report is really perfect for you. It's available to download for free on our website, and it has more benchmark report than we can certainly cover in this 40 or so minutes for the Appcast brief. But I will certainly try. So the first slide we have here is overall cost per application by month. And I am just focusing right now on that long ATS apply. And in February 2024, we saw cost per application slightly increase from January levels. We're currently at $17.02, but still well below the levels that we're seeing in previous years. Just to illustrate that, did want to compare February numbers, so 2024, to February of 2023 and February 2022. And right now, again, that $17.02 cost per application is well below, about $7 below 2023 levels, and more than $10 below 2022 levels. So again, to Julius's point, when we're seeing a labor market and more people opting to labor force, less job postings, it all equates to a lower cost per application. And one of the big factors for cost per application, as we know, is apply rates. So just to quickly go over the definition of an apply rate, of the job seekers who are clicking on your job ad, how many are going on to complete the full application? And in February, we saw this number tick up from January levels, currently now at 4.38%. So this is certainly strong, again, just far above the levels that we've been experiencing in previous years. And certainly, I think this is indicative of job seekers being a little less choosy than what we saw in 2022. So, some of the job seekers, again, in peak 2022, really like to shop around, look at a few jobs before applying. Now, with selection a little more limited, we're seeing them apply to a much higher percentage of those jobs. And now to show the easy apply process, some love. So again, this is looking at those short form applications, the really frictionless apply processes. In February, those cost per application was at $6.02, about the same level as January. But again, taking down pretty definitely more than what we were seeing in spring 2021. And a large reason has to do, again, with apply rates. So in February 2024, we did see apply rates tick down a bit for easy apply, now at 14.39%. but still just well above the levels we were at before. And now digging into some industry-specific numbers. I'm comparing February 2024 cost per applications to the cost per application from January, so just 1 month ago. What industries have seen the biggest cost per application change in this and the lowest? And so at the top there, we have our overall increase, 2.2%. And some industries that really drove this growth were technology and sales. And you can also see some other typically expensive sectors, and they're like, I'm looking at healthcare, warehouse, and logistics also saw that slight increase. But then we also had some industries on the reverse end. Food service and construction actually saw decreases in CPA. So again, against that overall trend, but definitely worth calling out. And then double clicking on some of these industries, we can look at some of the top job types, or we call them tag categories, within these industries. And so for me, the headline here is software developers. We saw a 115% increase in cost per application from January. Obviously, this is a very large number. More to come on this later. We'll look at the full month breakdown. But we also saw an increase in cost per application for a variety of other job types. I'm looking at critical care nurses. I'm looking at janitors and cleaners. A few more moderate increases, heavy tractor trailer truck drivers and warehouse, which Lance will expand upon in the last section of the Appcast brief. And then again, also wanted to call out some of the job types where we saw lower cost per applications. So electrical engineers, dockers, and order fillers, these are all job types that we've been looking at pretty consistently month over month during this Appcast brief. So it was quite interesting to see these these pretty strong decreases in cost per application as well. Then I told you I would look at software developers a little closer. So as you can see here, we are now at $21.92 for your cost per application. However, before I get too excited about about this potential trend, we're still below February 2023 numbers. So yes, we saw the increase. Yes, it was big. But I think the question now is this a trend, or is it maybe just a bump in the road? So obviously future months will tell that, but we're still yet not at those peak 2022 numbers. And then beyond looking at job types, we can also look at different geographies. So what states are seeing higher cost per application as well? And as we all know, that markets can get more specific. You know, we can look at MSAs, we can even look at county level. There's also just different job types in here. But again, this hopefully should give you at least an overall picture of where we're seeing the cost per application trends. And when I look at this chart, first off, there's a lot of purple. So it's not surprising when we know there's an overall cost per application increase that we're seeing many states individually with also that increase. But when I look where the purple is, some of the states with the highest population also have those increases. I'm looking at California, I'm looking at Florida, even Texas has that slight increase in cost per application. And then on top of that, we're also seeing increased cost per application in areas that are already expensive, that just continue to get even more expensive. One of the few of the areas that I specifically want to call out, the Midwest. So I'm looking at Wisconsin, I'm looking at Illinois, I'm looking at Ohio, are all getting more expensive. I go to the Northeast and New England area, a little more subdued, but we have Rhode Island, we have Vermont seeing pretty steady increases. And then finally, the West Coast, Pacific Northwest, also tend to see higher cost per application. So not surprised for me to see the Californias, the Washingtons, even Idaho, with really Oregon as the only exception there. And then as we segue into the last section, Freelance did want to call out driver-specific cost per application. The heavy tractor trailer truck driver saw a slight increase in cost per application in February, and the light truck drivers saw a decrease. I don't want to steal Lance's thunder, so I'll leave it to him to say whether this is maybe a blip in the radar or an overall industry trend, but definitely worth monitoring. And as we know, like I've said before, we know apply rates have a large part to do with cost per application. Over the past 3 years, we've seen those heavy and tractor trailer truck drivers apply rates really just skyrocket. They're nearly double what they were in the spring of 2021. And it's, even over the last year or so, we've seen that increase. And then light truck drivers follow a similar trajectory, maybe certainly not as strong, but again, just seeing higher apply rates over the last year. And with that, I will transfer over to Lance.
All righty. Good morning, everybody. I'm going to go over basically transportation logistics recruiting with a big emphasis on truck driving and truck driver roles, as well as some warehouse roles. If you want to skip to the next slide. The first thing I look at is first quarter job posting demand trends. Now, this is when employers are reaching out to our team here at Appcast and saying, boy, we really want you to focus on this particular role or these particular roles. No surprise to anybody in the transportation logistics space, diesel technicians, that is the hot commodity right now. Everybody wants them, everybody needs them, and there does not seem to be enough of a supply to satisfy the needs of transportation logistics companies. A little bit of a surprise right behind that, rail conductors. We've got a demand for rail conductors in both Canada and the United States, both for transit and for traditional rail shipping operators. That was not quite expected on our side, but it was a pleasant surprise to see that side's kind of growing in demand as well. Transportation and logistics sales. That's another positive sign for the industry. When folks are reaching out and wanting to increase their sales teams in a market that had been suppressed for well over a year now, it's a sign of confidence. It means that some of these transportation logistics companies are in a position where they feel they're ready to start scaling again, start trying to get that new business. It's a sign of things to come, being a very positive sign. Regional and OTR drivers up a little bit. People are still looking for regional and OTR drivers. Warehouse shipping and receiving has been down. Oddly enough, a lot of warehouses are reaching capacity. They've got roles all filled for material handlers. Some of the sectors that are a little bit struggling still, food distribution's still a little bit tough in some markets. That's mainly a supply issue, where a lot of folks have built warehouses in markets where there's just not enough of supply to staff all of the warehouses, and it's playing catch up. And then local and dedicated trucking. This is Class A. That's not the light trucks. Local and dedicated trucking down a little bit. The number of postings are down. Trucks are filled. A lot of clients are, and other folks that I speak to in the industry are, their trucks are full and actually building wait lists and getting truck drivers lined up for when roles do open up again, which that's something, if you want to travel back in time a year and a half, nobody would have ever thought that possible. Move on to the next slide. Big question I get asked all the time is demand for CDL drivers going to return in 2024, and if not, when? I get that so many times, it's almost painful. I figured I'd go ahead and dive into that a little bit here because I get that question asked a lot, and I wanted to explain first, if you want to skip to the next slide, the factors that led to our current situation where we're not having that driver demand that we once had. I kind of did it in a little bit of a timeline, but these factors can kind of jump one in front of the other, but these are the factors kind of affected where we got here. Started with fears of a recession and rising interest rates. Rising interest rates in trucking, it's kind of a scary thing because whenever interest rates rise, manufacturing starts to slow down, building starts to slow down a little bit. People are less likely to make purchases of new trucks, new warehousing. So the rising interest rates definitely kind of hurt us a bit. Consumer spending started to decline with the fears of the recession. If people aren't spending, if we're not buying things, trucking takes nosedive. Reduced manufacturing. If people aren't buying stuff, manufacturers start to slow things down. Maybe they'll cut that third shift of production and just go down to 2 shifts. Maybe they'll go down to 1 shift. And if the production goes down, then the import of materials goes down, which affects the ports. It affects trucking inbound for all the raw materials. And it's just a spiral that kind of led us to where we're at. That trucking demand ended up collapsing and truckload rates plummeted. A lot of the trucking companies that I speak to, the executives there, they had a couple different approaches. With the trucking demand really soft and the rates plummeting, a lot of them tried to control their expenses by canceling orders on trucks or not replenishing trucks the rate they used to. If they cycled them on a 3-year cycle, maybe they went to a 4-year cycle, a 5-year cycle. And yeah, it just, if you're not bringing in more trucks, you're not bringing in more drivers. At most companies, driver supply caught up with the demand. And like I mentioned in the previous slide, they end up getting their trucks filled. Now, driver hiring at many carriers has been reduced and even eliminated. There's companies that they have mechanic openings and don't have very many driver openings. And then there's other contributing factors such as fuel costs have been unusually high. Lastly, blank sailings of the ships definitely affected things. When you send container ships one direction empty, it's never a good thing. You want product going back and forth both directions. And then we obviously had some trucking bankruptcies. Yellow being by far the largest, ugliest thing that we've had to endure. That created a glut of really competent drivers on the market, as well as warehouse people and material handlers. So that's kind of what the factors that led to where we're at. I want to skip to the next slide. So basically what that does is that creates this wonderful little chart that I like to refer to. When transportation demand goes up, transportation supply typically has to go down in order to correct things. And where you really want is you want that balancing point of the teeter-totter. Unfortunately, the industry always seems to go bouncing back and forth. There's always more demand or there's more supply, and the freight rates respond accordingly. If in a perfect world, we'd land somewhere in the middle of that X and we have supply meet demand. But unfortunately, we tend to teeter-totter back and forth. And right now, demand is down and supply, transportation supply, has had to recede. That's where a lot of trucking companies have basically dialed back their fleets and not replaced them in order to try to increase the demand. But I think we're right at the tipping point. Consumers like to consume. Are we going to rebound? Retailers like to sell, manufacturers like to manufacture, importers like to import, cargo ships like to sail full, and distribution centers like to distribute goods, and trucking companies like to truck it. I mean, the reality is this industry wants to work. Will it return? It has to, mainly because we like to buy stuff. And how to spot a transportation recovery. The first thing that tends to happen is folks start making and financing larger purchases, and they invest more often and they travel more frequently. That's the confidence in the economy that we're looking for, and we're starting to see some inklings of that. Confident capacity. When folks are confident in the capacity, they'll purchase more equipment. They'll buy more Class 8 trucks, they'll buy more trailers, There's large marine vessels that are getting unveiled this year. That's going to increase the capacity of ocean-going freight. I believe it's 44% with the new ships that are coming on board, some really big ones. They'll build, lease, and buy more warehouse and distribution centers. They'll advertise more transport and logistics jobs and hire more employees. And we're starting to see a little bit of all of these, and I'll cover that in the next slide. And then confident manufacturers. If manufacturers are confident in the recovery, we'll see growth in the manufacturing sector. Start seeing 2 shifts and 3 shifts running and a lot more products being distributed. And that means more logistics and more warehousing. Next slide. Now, are we seeing some of these signs that are coming on? Year over year, Class 8 truck orders have gone up from 44% in January, which that's definitely a good thing. Now, historically, a lot of folks like to buy trucks at the beginning of the year. That's part of the trend, but last January, that was not the case. The U.S. Federal Reserve, the interest rates have been flat. They haven't been increasing them. I, for one, am a big vote for bringing them down a little bit, but yeah, they've been flat, which that's a positive sign. Job postings have increased for transportation and logistics sales, which I mentioned that in a previous slide. If you're looking for salespeople, that means you're expecting more volume to be coming. Carriers are reducing capacity. That seems to be a trend that they're doing to respond to the freight rates. And whenever you reduce capacity, freight rates tend to tick up. And then flatbed load volume, people are building. Again, there's some seasonality to that, but flatbeds, once construction starts, there's a whole lot of other transportation that has to happen. Some of the less positive signs, spot freight, spot market, still suppressed, still looking ugly. People watch it on a daily basis, almost like the stock market, and it gets a little bit creepy. But the numbers aren't what they used to be. New container ships are being delivered. I mentioned that. That's going to create more capacity, which worries some. Overall, container shipping rates remain low, volume remains low, and then most regions are experiencing truckload rates that are still pretty low. So there's negative elements and positive elements, but if you go back a few more months, it was a lot more negative signs than positive signs. So conclusion, things are consistent that we're starting a recovery on the freight and the transportation side. We're starting to see that inkling, and I was a bit of a naysayer thinking we were looking at 2025, but I'm starting to kind of maybe shift my position that late spring, early summer, we'll start seeing a little bit of a rebound. That's it.
Perfect, thank you. We have a couple of questions that came in, so maybe we should just answer those. One is interesting, Josh. Maybe you can weigh in as well. So the question was whether pharma is part of the healthcare job gains that I discussed or not. And so basically the healthcare sector, when I said there's like the healthcare sector has been adding 60,000 jobs on a monthly basis, what kind of jobs do these entail? All of these are like nurses and social assistants, doctors, so all of that is classified as healthcare jobs. But pharma, interestingly enough, is probably not. It is under medicine manufacturing. So pharma jobs should be under the classification of manufacturing jobs in the US. If that makes sense. Then there was one more question about the recent revisions to the US job numbers. Josh, do you have something to add on those?
No, I don't. I think there's certainly, I think, bigger revisions than maybe initially expected, but to your point, I think the numbers which they're getting revised to are generally closer to where forecasters were originally expecting. But I'll leave it up to you too for additional insight.
Yeah, that's a very good point. So like the revisions that happened over the last couple of months kind of brought down the actual numbers more in line where the consensus was in the very first place. So job growth over the last 3 months has been very, very strong. As I said, some 260,000 jobs added every single month, which is still far above trend in a sense. So the negative revisions obviously are never good news. But with a negative revision from January that brought the actual number more in line where forecasters expected the job numbers to be in the first place. So as of now, I'm like not very worried about the revisions right now. Do we have any other questions? I think maybe summing up just one point from all of us, I would say that again, this has been a very good jobs report. It's very good news for the Fed, and the US economy is still kind of in a sweet spot, and the Fed will just love to see those numbers. Wage growth coming down slightly, GDP forecast still relatively high, and job gains still extremely strong. Josh, do you have something to add?
Yeah, we're starting to see increasing cost per applications, but only slightly. So, future months will tell whether that, was just a blip or a trend. But to Lance, I'll leave it to Lance, but I think we are starting to see maybe the starting signs of a return in cost per application and apply rates. I'll pass it over to Lance.
I concur. It's a supply and demand issue. Right now, there's a lot of a supply and a little bit of a lower demand on transportation and warehousing, and that obviously kind of affects it, drives everything down. Once there's a little bit more of a competitive landscape and there's more job postings out there, and people start gobbling up that supply, yeah, it inevitably when there's a want, there's a price tag to it.
Sounds good. And I think with that we can finish the this month version of the Appcast brief. Really hope to see all of you again in 1 month from now. So that's it from us. Thanks a lot.
Thank you all.
Thanks, everybody.